And I want to finish this part by talking in a little bit more detail about the point I started with in section 1, that is the link between customer relationship management and market capitalization or shareholder value. So let me remind you, shareholder value is roughly equal to the share price times the number of outstanding shares. This in real life is a little bit more complicated because companies tend to have different types of shares and you would need to take account of this, but let's just keep this as a separate problem for the moment. Shareholder value assumes that a firm is publicly traded because obviously if it weren't publicly traded, there is no share price. And very often you can also hear the term market capitalization, which is more or less the same thing. If you are a private firm, you can't really use shareholder value, but you can use techniques from finance, let's say net present value analysis, to approximate that value. Why does it make sense to focus on shareholder value? Well, the share price is easily observable and constantly updated. So you can calculate shareholder value more or less in real time. This is very helpful when you want to understand how certain actions impact shareholder value. If a company makes a new product announcement, if Apple announces, for example, that they have a new iPhone that is coming out, you can immediately track how the share price reacts and based on this calculate whether this new announcement has created shareholder value or destroyed shareholder value. And another advantage is that shareholder value can be compared across all sorts of industries. If you look at balance sheets and profit measures, for example, it would be really hard to compare a service company, a technology firm, a mining firm, an automotive producer. They all are so different that their financial data as in an accounting system cannot really be compared. But shareholder value makes everyone equal because shares are traded on the same market, so share prices can be directly compared. Shareholder value assumes that investors are rational, and if they are rational, then the share price reflects all available information. So it's our best guess of how much the company is worth at a given point in time. Conceptually, shareholder value is impacted by two factors, profitability and the invested capital. Profitability is a function of revenue minus cost. So market share and sales growth from the revenue perspective and cost of goods sold or income tax rate for the cost perspective all impact profitability and ultimately shareholder value. And the invested capital, you can split into working and fixed capital. So something like inventory cost or physical asset and capacity utilization also directly impact shareholder value. If you want, you can make a tree of shareholder value drivers similar to the one of this slide that shows you how different actions translate into shareholder value. You can, for example, calculate how a change in market share probably translates into an increase in shareholder value. We will do something like this in a minute when we look at the impact of CLV and customer equity on shareholder value. Now, one question that you can ask is, how can marketing in general conceptually influence shareholder value? Well, to understand this, you need to understand what shareholder value actually is. And in a certain way, it's the net present value of the cash flows that we expect from the firm over time. If these terms do not make much sense, go back to one of your finance classes or check them out on YouTube. But one easy way of seeing shareholder value is that you plot the cash flows of a firm over time, then you discount it, and that result is roughly shareholder value. What marketing can do is it can impact cash flows in two different ways. First of all, it can enhance them. So it can shift the curve upwards. For example, because if we have marketing, we can charge a price premium. We can cross-sell products and services. We can lower our sales and services cost. So if we have market-based assets, if we have a strong marketing, and this is very broad, it includes customer value management, but you can make the same argument for brand equity, which is another market-based asset, it leads to more cash flows. So it pushes the curve upwards. But it also pushes the curve slightly to the side because it can accelerate cash flows. If you have a very strong brand, then consumers may be more likely to buy a new product earlier and brand trials can be accelerated. If we use referral reward programs that we discussed in session 2, we get the customers sooner, and again, our cash flows get accelerated. And conceptually, the enhancement of cash flows and the acceleration of cash flows together lead to more shareholder value. So how does this translate when we want to do customer value management? Well, if we want to do customer value management and relate it to shareholder value, what we need to do is the following. We need to look at customer lifetime value, and based on this, we calculate the customer equity as the sum of all customer lifetime value. The customer lifetime value is determined by the exchange characteristics, the level of marketing communication we do, the cross-buying that we do, and of course, maybe also demographic factors. And this is one component. And the second component is we take the stock price and the number of shares and calculate the market capitalization. And then we try to link the two together. We try to link customer equity and market capitalization, controlling for certain finance-related factors like volatility and vulnerability factors. Now, you can do this using equations, and I put an article into the supplementary reading that does this in detail. And I don't want to scare you too much with these equations, but just look at the equation that you see on this slide. This slide calculates CLV for every customer. We just number the customers, and so we call it customer I, CLV of I. And how we do this is we take a period of 36 months. We don't take the entire lifetime, we just take 36 months, and the article would explain to you why this makes sense. So we sum from 1 up to 36 months. And what do we sum? Well, we sum the probability whether you bought in any given month times the contribution margin that we make. And we take away from this the number of times we contacted you in marketing times the cost of marketing. And if we calculate this CLV for each individual customers, we can look at the distribution of CLV, and you find on the right-hand slide something that we already saw when we talked about unprofitable customers, namely that about a third of the customers have negative CLV. Some have really very negative CLV of 142 in this case. Some have a slightly lower negative CLV. But what is interesting is that the chart that you see on the right hand of that slide is very similar to the chart that I showed you in session 1 when we looked at the retail bank, where I did this analysis myself. But the key thing we are interested in is whether customer equity is related to shareholder value, and you find it on that slide. You essentially find that there is a correlation of about 0.8 between a change in customer equity and a change in shareholder value. So there's a very strong link between what we do in terms of customer value management and customer equity and the creation of shareholder value. And the chart on the right-hand side shows you that we can leverage this. Because by doing the things that lead to a particularly high increase in shareholder value, we can increase shareholder value disproportionately. So this is what you see here. You see the average monthly stock price before the company developed the CLV-based strategy maximization afterwards. And this is the end of this session. So I hope that in these first 5 sessions, or in the first half of this class, I showed you what CRM is, how it is important, why is it important, and how it relates to things like big data. And then we talked about how customers can be evaluated, how they can be put in a pyramid, either based on their purchase, we talked about CLV, or based on their social interactions. We then talked about how customers can be handled differently, using the examples of loyalty programs and unprofitable customer management. Then we moved to how we can generate data from customers using the concept of data mining. And today we talked about how all of this can be implemented and whether we can actually empirically show that customer value management, customer equity, and market capitalization are related. What we will do in the following 4 sessions of this class is we will look into the impact of pricing. In a certain way, you can see that now we have found out how much each customer is worth, and we try to manage them in a way that they get worth more, but we need to extract that value out of the customer relationship. And this is what pricing is about, and this is what we do now in session 6 going forward. So see you next week.